Have you ever noticed those huge container ships at the port and wondered just how much these colossal sea monsters can carry? Ever wondered how much would be lost if something were to happen to a cargo ship? Millions of dollars will be lost. But who would pay for it? In this article, we'll go deep into what is marine insurance and what does it cover. Marine insurance is that class of insurance that covers goods being transported as well as the ships, sea-going vessels, terminals and other forms of transport ferrying those goods. A lot of people assume that marine insurance only refers to cover for goods on sea-going vessels and on ships. The cover is broader than that. It refers to cover for the goods even when they are on land, which is road, rail, air, ship or even barges. Most of the time when goods are transported, they move from one mode of transportation to another. For example, from ship to road, even to rail. Hence, it's more convenient to provide blanket cover for the goods, whether they are on land, sea or air, from their origin all the way to their destination. As a brief background on marine insurance is one of the oldest forms of insurance. It's generally agreed that the Chinese started marine insurance at around 3000 BC. It then grew to its modern form through centuries of evolution. Global trade probably wouldn't be what it is today without marine insurance. The risk of loss will just be unbearable for merchants, as they would need insurance to cover their products. Now, there are two broad classes of marine insurance. These are ocean marine, which covers primarily water-based exposures, and inland marine, which covers primarily land-based exposures. It is critical that we understand the difference between marine insurance and inland transit insurance. Let's talk about marine insurance versus inland transit insurance, also known as goods in transit insurance. The difference between marine insurance and goods in transit insurance is that marine insurance covers goods while they are being transported across borders. This is from one nation or from one country to another. On the other hand, inland transit insurance covers goods while they are being transported within the same country or nation. Now, for the purposes of this discussion, we're just going to be focusing mostly on ocean marine insurance. Now, open marine insurance versus facultative or once-off or voyage insurance is what we're going to talk about now. Now, open marine cover is a type of insurance policy which covers the customer for all their voyages or shipments for a set period of time. However, facultative marine cover is whereby the customers insure their assets on a per voyage basis. Now, why is marine insurance important? Now, when businesses or individuals transport their goods from one point to another, they need assurance that their goods are safe. They know that some peril may occur, but at least they have assurance that they will be compensated in case a loss happens. Now, marine insurance offers this type of protection. Now, imagine if you buy some fragile solar panels from China. You need to know that you will get them whatever happens. You need certainty that if something happens and your panels are stolen or damaged, then at least you get some of your money back. Now, with marine insurance in place, investors, bankers and other financial institutions can offer funding for ventures that need imports. This is critical in undertaking huge construction projects and business ventures. Needless to say, removals companies need to assure their clients that they will provide compensation to them in case something happens to their goods. Now, consider the owners of these mega million-dollar boats. They need assurance that their vessels are safe from accident in much the same way as you need car insurance for your motor vehicle. So what does marine insurance cover? Generally, marine insurance can be summarized as covering cargo and freight, the vessels themselves, as well as third-party liabilities to cover legal cases that may arise against third parties, even revenues or cover for lost revenue or profits in case of loss of goods belonging to the customer. Because remember, the customer will lose profits in case the goods that they've been waiting for do not arrive, and they intended to use those goods for producing or for production purposes, so they would have lost in terms of their profits. Now, there's also what we call institute marine clauses. Now, insurance cover for cargo is done through what are known as institute marine clauses. These are clauses that were adopted as terms by most of the large marine insurance or marine organizations. These include the Institute of London Underwriters and the American Institute of Marine Underwriters. Now, you can, if you go to the engineering insurer website, you can be able to get access to these marine cargo clauses. Now, these clauses can cover the cargo or the freight as well as the container and the ship itself. Now, the difference between cargo and freight is that cargo refers to goods carried by ship or by airplane. However, freight normally refers to goods carried by road or rail. It is critical to note that the Institute cargo clauses no longer refer to cargo or freight insured as goods, but rather right now they refer to them as subject matter of insurance. Now, you will notice that the widest cover under the Institute marine clauses is offered by Institute Cargo Clause A. More restrictive cover is offered by Institute Cargo Clause B. And the most restrictive, of course, is offered by Institute Cargo Clause C. Now, it is also important to note that the less restrictive the cover, the more expensive it is. I think that's a general rule in insurance, right? Okay, so just basically, what does Institute Cargo Clause A cover? This cover provides cover on an all-risk basis and does not specify any perils. Of course, it will exclude all other exclusions such as your war risks and any other like willful acts and gradual deterioration. Those general exclusions that apply to insurance policies. Then you find that Institute Cargo Clause B has got specified covers like fire and explosion, a stranded or grounded ship or capsized ship, or even entry of sea or lake water. That kind of thing. But Institute Cargo Clause C does not include the entry of sea or lake water and the total loss of any package lost overboard or dropped while being loaded or offloaded. Now, it is important to note that however comprehensive some of these covers may be, there are exclusions, you see. And some of the exclusions under the Institute Marine Cargo Clauses include willful misconduct of the assured, willful acts, your ordinary leakage, your loss in weight, your wear and tear, war exclusions. Again, if you visit the engineering insurer website, you can see a more comprehensive list of these. Now, when we want to insure like your hull or boat insurance, or what do insurers consider? Now, in order for us as insurers to insure your boat, we always look at the sum insured. How much is your boat? The age of that boat, when was it bought, when was it manufactured, what do you use it for, you see, because obviously higher risk work like commercial works, they attract higher premiums, you see. If it's a sporting vessel, obviously it will attract a higher premium because it has got a higher risk of damage or loss. Even the type of vessel, its construction, is it one of those timber vessels or is it a metallic vessel? Even the claims experience of not just the vessel itself, but even the captain or the skipper. What is their loss history? You see, right? So you find that on top of those marine cargo clauses that we spoke about, there are other special trade clauses for covering a higher risk materials such as oil, timber, fats, frozen foods, and even rubber. You see, and many other higher risk goods of this nature to need some sort of special treatment in terms of insurance cover. So you may also ask, what is commercial hull insurance cover? Well, commercial hull insurance covers perils of the seas, fires, explosions, earthquakes, violent theft, jettison, and piracy, towing costs, all sorts of these covers that might be needed for your vessel. Now, what is also important is to ensure that you discuss with your broker or with your financial advisor on the types of covers that will be more suitable for you. Right. We also have got pleasure craft. If you've got your yacht, what sort of cover would you need? You see, so most insurance covers for pleasure craft include, perils of the seas, fires, explosions, lightning, volcanic eruption, theft, loss of outboard motors, and even liability to third parties. Now, who can buy marine insurance cover? Now, marine insurance cover can be taken up by anyone in the value chain of importing or exporting goods. The important thing is that they have some form of insurable interest. The parties may have insurable interest and therefore insured goods include your buyers, your sellers, your financiers or the banks, your import and export merchants, your freight forwarders, and even your contractors. Now, the decision on who is to purchase insurance depends on the contract of sales. The three main types of contract include, your FOB or your free on board, right? Or your CIF, your contract, your cost insurance and freight, and your C&F, which is the cost and freight. So with the free on board, we've got two types of these. We've got the free on board FOB shipping point or FOB origin, where the buyer owns the goods as and when they leave the factory or warehouse or point of origin, therefore is responsible for insurance at this point. In this case, and then in FOB destination, the seller is responsible for any losses right up until the goods reach the buyer or the named place of delivery. Now, if you look at cost and freight, the seller must pay for the cost and freight necessary to bring the goods to a named port or destination, and must also procure marine insurance against the buyer's risk or loss to the goods during carriage. And then what about the cost insurance and freight? Here the expense, this is like your CIF is the expense paid by the seller to cover the costs, insurance and freight of a buyer's order while it is in transit. The goods are transported to a port named in the sales contract until the goods are fully loaded into a transport ship. The seller bears the cost of any loss or damage to the product. Now, once the freight loads, the buyer becomes responsible for all the other costs. How do you calculate marine insurance premium? Now, just as with all other insurance classes, the premium charged is dependent on the value of the insured item and the rate given by the underwriter. It therefore follows that the more expensive the item to be insured, the higher the premium. The rate, however, is dependent on the insurer's perception of the likelihood of loss. The higher the perceived risk, the higher the rate and the higher your premium. Now, perception of risk is governed by a number of factors, and these are the same as those that we've already spoke about. Now, for cargo cover, the insurer applies a rate dependent on the nature of goods, the quantity of the goods, origin and destination, as well as the road, any inherent risks or hazards that the goods may have. For example, if you're transporting fireworks, there is higher risk of explosion, as well as the loss experience of the goods in question, the customer's loss history, and the extent of cover required. You see, for example, if you require more comprehensive cover, that means you might be charged more. You see, now with that, the underwriter then simply multiplies that rate of insurance, which may be 0.5, maybe right up to 5%, multiplied by the sum insured or the total value of those goods. How do you claim for marine insurance losses? Right. So claiming for marine insurance is pretty much the same as claiming for any other insurance loss. Hence, as the claimant, the important thing is to ensure that you fully understand and you provide information on the proximate cause of the loss, which is covered by the policy. You have to make sure that proximate cause is covered by the insurance policy, and you have to confirm, of course, that your premium has been paid. Of course, the insurers can also be able to tell that from their records, but it's always good to have your own evidence just in case you need it. And you also need to be able to verify the insurable interest, like who owned the goods at the time of loss, who was responsible for insurance at the time of loss, which will take us back to our CIF, C&F, and all the FOB contracts that we spoke about. a few moments ago. And then you also have to ensure that you complied with the policy warranties. Remember, if you breach warranties, then your policy becomes voidable or becomes void, right? And you also be able to should be able to confirm that the loss occurred during the currency of the policy. That is, the loss occurred while you were still covered by the policy, because if the loss occurred after your policy or maybe had expired, then that means you will not have been covered by the policy. Otherwise, thank you very much, guys. Please visit our website engineeringinsurer.com for more information. If you have any other information that you need, please just let us know in the comments down below. Please like or subscribe our video. God bless you. Have a good day or night.